All right, let's get right into it. Welcome to the ultimate guide for what might be one of the most important accounting standards for your exams, AS22, Accounting for Taxes on Income. Let's make sure you're totally ready to ace this. Okay, let's start with a hard truth. If you've been thinking that the tax expense you see in the profit and loss account is just the profit multiplied by the tax rate, well, you're walking straight into a trap that has cost so many students their precious marks. So what's really going on here? Just imagine this scenario. Your company's books, your P&L, proudly show a profit of 100. But then the income tax department takes a look and says, no, as far as we're concerned, your profit is only 70. So who's right? And the million-dollar question for your exam is, how on earth do you figure out the real tax expense to show in your financial statements? This right here is the exact puzzle AS22 was created to solve. First things first, let's get to the bottom of that puzzle we just talked about. Why in the world do we even have two different profit figures to start with? And here's the answer. It's because we're essentially living in two different worlds. On one side, you have your accounting income, or what we call book profit. This is the number that comes from your P&L account, following sacred accounting rules like the matching principle. But on the other side, you have taxable income, or tax profit. This one follows a completely different rulebook, the Income Tax Act. They're like two different languages, so of course they're going to come up with different numbers. So let's be super clear on this. Accounting income. It's just the profit you see on your P&L statement before you subtract a single rupee of tax. Simple as that. It's the profit from your operations according to your books. Taxable income, though, is a totally different story. This is the only number the taxman cares about. It's the profit you calculate using all the weird and wonderful rules, deductions, and allowances that the Income Tax Act allows. This is the figure you actually write the check for. So, this is where our hero, AS22, swoops in. Its entire mission is to bridge this gap. You see, it's all about applying the matching principle to taxes. AS22 makes sure that the tax expense you show in your P&L is perfectly matched to the accounting income you earned in that year, even if the cash for the tax is paid at a completely different time. Okay, this leads us to the two big reasons why these profits disagree. You can think of them as two kinds of gaps. One gap that we can build a bridge over, and another that's just, well, an unbridgeable canyon. First up, we have timing differences. Now listen closely. This is absolutely key. These are differences that start in one year, but, and this is the important part, they will reverse or cancel themselves out in the future. The classic example is depreciation. Maybe the tax law lets you write off 100% of a research asset in year one. Awesome. But in your books, you're using SLM over 10 years. The expense is different each year, but by the end of year 10, the total amount you've depreciated is exactly the same. The difference originates, and then it reverses. And then you have these guys, permanent differences. The name says it all, right? These differences show up, and they never, ever go away. Think of a penalty you paid. It's an expense in your P&L, but the tax law says, nope, you can never deduct that. The difference is created, and it's there forever. Now, I want you to burn this into your brain, because they never reverse. Permanent differences do not create deferred tax. This is a classic trap, and it's where a lot of marks are lost. Okay, so we know that timing differences are the gap. So how do we actually build the bridge? Well, we've got two special tools in our accounting toolkit, a deferred tax asset, or DTA, and a deferred tax liability, or DTL. So let's talk about how a DTL comes to life. This happens when your accounting income is higher than your taxable income. That means you get to pay less tax today, which sounds pretty great, right? But hold on, it's not a free lunch. You know that because of this timing difference, you're going to have to pay more tax later. So what do? You create a provision for it now. That provision is your deferred tax liability. It's a liability for tax you'll pay in the future. Now let's flip it for a deferred tax asset. This is the exact opposite situation. Your taxable income is higher than your accounting income, so you end up paying more tax today than your books say you should. You've basically prepaid your future tax bill. And what is a prepayment? It's an asset. You've created a future tax benefit for yourself, and that's exactly what a deferred tax asset is. But wait, there's a huge flashing warning sign when it comes to DTAs, and it's all about prudence. This is a massive exam trap. You can only create a DTA if you're reasonably certain you'll actually make enough future taxable profits to use that benefit. Think about it. It makes perfect sense. What's the point of recording an asset if you're never going to be able to use it? IKAI loves to test this by giving you a company with losses and asking if you should create a DTA. The answer always comes down to whether there's solid evidence of future profits. Okay, so we've got the concepts down. Now let's get into the nuts and bolts. How do we actually put a number on this stuff, and where does it go in our financial statements? The basic rule for measurement is pretty simple. You use the tax rates and laws that have been officially passed by the balance sheet date. But you knew there'd be a but, right? This is where ICAI loves to throw a curveball. They'll use the phrase substantially enacted. This means a new tax rate has been announced and is so far along in the legal process that it's practically guaranteed to become law. If you see that phrase in a question, you have to use that new rate. It's a classic trick. And here it is, the formula that brings it all together in your P&L. The total tax expense you see is actually made of two parts. It's your current tax, the tax on this year's taxable income, plus or minus the change in your deferred tax for the year. This is how we achieve that perfect matching we talked about. Now, on the balance sheet, you can't just hide your DTA or DTL. They need their own separate line item. Then, in the notes to accounts, you have to show your work. You need to give a breakdown of what's causing them, like depreciation, provisions, and so on. And connecting back to that huge prudence point, if you've created a DTA because of unabsorbed losses, you must explicitly disclose the evidence that makes you so certain about those future profits. Okay, everyone, pay very close attention here. This is a major source of confusion, where marks are just thrown away. Offsetting. For current tax, it's straightforward. You can net an asset and a liability if you have the legal right and you plan to settle them as one amount. But for deferred tax, the rules are different, and this is the trap. You can only offset a DTA and a DTL if 1, you have the right to set off your current tax items, and 2, the deferred taxes are for the same tax authority. The logic is, if you can't even net off this year's tax, you definitely can't net off your future tax. Do not get these two rules mixed up. All right, you've got the rules, you know the concepts. It's time for the final boss level. We're going to tackle one of ICI's absolute favorite and trickiest exam questions, the tax holiday scenario. When a company is in a tax-free holiday period, the logic is actually pretty simple. If a timing difference starts and also reverses inside the tax-free window, there's no tax effect, right? So no deferred tax. But if a difference starts during the holiday but will only reverse after the holiday is over, then there will be a tax impact in the future, so you have to create deferred tax for it now. And the key assumption you must use for calculations is FIFO. The differences that arise first are assumed to reverse first. Let's look at this YLT'd example to see it in action. They have a 10-year tax holiday. In year 1, a 200 log timing difference comes up. In year 2, another 400. Using FIFO, we have to figure out how much of this total 600 log difference will reverse while the company is still tax-free and how much will spill over into the taxable period later. As you can see from the calculation, a small part of it is expected to reverse after the holiday ends, and it's only for that part that we recognize a DTL. It perfectly shows the principle in action. So I'll leave you with this final thought. After really mastering AS22, you will never look at the tax expense on a P&L the same way again. You won't just see a number anymore. You'll see a story about a company's past, its present, and a little glimpse into the taxes it expects to pay in the future.